I think it's always good to present another strategy out there besides just evaluating one trade at a time. I find that a lot of retail traders deal with a fairly myopic or have trader tunnel vision. What they'll do is they'll look at one opportunity at a time. The issue is that it's difficult, and one of the reasons that I would say, depending on what the market is doing, one of the reasons why I would say that is that, for example, over the last several months, we've seen retail trader accounts really decline. And it's not a big shock. I mean, if you look at the euro US dollar, you can see what's been going on. Historically, retail traders have a hard time dealing with markets like this. In fact, there's really two kinds of markets that retail traders have a real tough time dealing with. This would be one, so a channeling market, and on the equity side, a down market. And of course, if you add one to the other, you can see that over the last while, we've had a couple of extended periods of extreme channels across a lot of the majors, but including the euro US dollar would be a good example of this. And you'll see a lot of traders getting beat up in this kind of market because the volatility does not resolve itself into a trend. So traders struggle with this, even short-term traders who may be buying the bounces and selling the at resistance can have a difficult time because trading costs are fairly high during periods like this because trading frequency tends to go up. There's another example of another difficult situation for traders to deal with in the equity market. Basically, this is the S&P 500, and basically the commencement of the credit crisis back here in July through this period here, or rather, I should say the commencement of the price shocks from the credit market situation here in July through current period, we've been stuck in this emerging bear market. So this is another place that retail traders have a really hard time dealing with this. So where do we get this information? Well, we can track public reports coming from broker dealers, as well as just anecdotal evidence coming from dealing desks and institutional traders, etc. And it's just a reality of working in the market. However, what I found is that oftentimes the reason why traders are dealing with these kinds of problems and experience profitability issues during these periods is that they only look at the market from one perspective, and that is trying to catch the big move on a pair by pair basis. But there is an alternative. I've been actually had several requests for an update to the carry trade strategy that we implement here at PFX, and I think it's a good illustration of what are some of the things that you can do, not only during periods when the market is not volatile at all, but what can you do when the market is becoming very volatile and risk is really high? What are some of the things that you can do to try to preserve capital while still eking out some returns? There's a strategy that we manage on the site that we try to make as transparent as possible. It's one of those strategies that's implemented by institutional investors. It's not a particularly new idea, but a couple of the ways in which it's implemented, some of the strategic ideas behind this strategy are oftentimes ignored or underemphasized by retail traders, and I think that it winds them up into these situations where when the market gets volatile and more unpredictable, as we deal with things like the liquidity crisis, etc., where the market gets real volatile without an emerging trend, or emerging trends are difficult to find across the majors, it's one of these things that helps to smooth out that volatility while still allowing you to get some market exposure for profit opportunities. You never know when the market is going to begin to trend again, and being in the market but controlling your risk at the same time, make sure that you're there when the market does continue to trend, while making sure that you're adjusting as needed to the realities out there in the market. So in this case, specifically, I'm looking at the carry trade, and we split up the carry trade amongst 5 different currency pairs. And what we look for is an opportunity to trade basically the top 3 yielding currencies in the G10. The G10 includes things like the Aussie, the Kiwi, the yen, the franc, the euro, the Canadian dollar, on down the list. Norwegian krona, etc., where we buy those top 3 yielding currencies and cross them with the dollar. So we're buying those and selling the dollar against them. That would mean that for example, you'd be long the Aussie dollar. You can see it here on the upper left-hand corner of our portfolio. And we sell those that are the lowest yielding. So for example, that means that we'd be long the Aussie or the dollar yen. So we would be short the yen, which is one of the three lowest yielding currencies. If the dollar falls into one of those upper or lower three, then we just ignore it, and it means that we're basically trading 5 currency pairs instead of 6, because the dollar kind of eliminates itself. You wouldn't cross the dollar with itself. It's just one way in which to construct a tactical implementation around a strategic idea, which in this case is the carry trade. Keeping it diversified like this helps to reduce that inherent volatility that will occur in any trading strategy. Let me give you an example, okay? So this is, if we were to look at, well, what's our performance been over the last almost year? It's been about, since we've been illustrating this on the site, it's been about 305 days or so. And so we're coming up on a year. We're up about 6% or so. And there's a chart of those returns here included with the article. And so not a ton. The actual price appreciation, so actually the profits from being long or short these currency pairs is very, very small. We've made basically all of our money off of rollover, which is that's not unexpected when the market is really volatile like this. Once the market starts to trend and risk begins to decline, investors start to get a greater appetite for risk, returns really escalate, which has been the case over the last 10 years or so. Anytime your risk levels go down, you see equities take off, things like this, you'll see a strategy like this really burn it up, which is what we're looking forward to. But in the short term, while risk is high, it's a way to limit that volatility while not eliminating the opportunity for profits. But just as a comparison, you can see how the strategy up 6%, that's a little tough, but let's compare it against other asset classes. For example, over that same period, we've got the S&P. So we've been managing this particular strategy since the middle of September, and during that same period, the S&P or equities are down about 14%. So the U.S. is not alone in a decline in equity prices. Most of the major markets are down. So we've got bad performance here for long equity traders. Even strategies that, getting back to this whole concept of traders having a hard time dealing with more than one currency pair at a time, implementing a diversified strategy or a strategy around a diversified portfolio, a lot of traders will equate carry trade equals pound yen, which tough. During that same period, the pound yen has been down 8%. So if the portfolio had been very leveraged and invested exclusively in just one currency pair, that could turn into a real loss. So one of the other questions that I've been asked is, well, how do you balance the portfolio? In other words, what's your weighting? Well, in our case, there's a link, by the way, to a couple of articles and some videos on exactly how did we weight the carry trade, how do we chop up the money, what kind of leverage do we have in the portfolio. But the current weighting, as you can see here, this is just currently how it's allocated. And the idea is to keep that notional value as denominated in US dollars equal, so that we don't become unintentionally overweight in the dollar Norwegian krona, which can move quite a bit. Although its pip value is very small, it can move 300, 500, 600 pips in a day pretty easy, and it's important to try to keep that equally weighted as much as possible, at least in notional value, against, for example, the Aussie or the dollar yen or even the dollar franc, where you have in that case, you have something that's very close to parity with the dollar. So as you can see here, it's not an equal number of contracts per trade. It's equal according to the notional value is denominated in US dollars. And there's a link to an article on how to do that. You can get a lot more detail on that. But it helps to, again, constrain that volatility. So that's something that we're looking for. So a little update. I hoped to maybe introduce some food for thought. And if there are traders out there, which I'm sure that there are, who are struggling a little bit with profitability and risk while the market is, while we're dealing with an increased level of trader risk or negative trader sentiment, at the same time that we're dealing with a channel across so many of the majors, this is one way in which you can start to neutralize some of those risk factors and withstand these periods in the market so that you're ready for and already deployed in the market when things turn around, you can catch the trend.